where the commodity price is selling for less than the total cost of production, is one where you will see a price increase. So specifically, I will sell my gold, which is to say, I will believe that the gold bull market is over when the following circumstances occur. It wouldn't surprise me if gold and silver prices both needed a rest. They've had a pretty dramatic uptick. A couple days ago, somebody asked me online when I would sell my gold, which is related to that question. And maybe that answer would be useful for your audience. Gold historically has done well when people are concerned about the maintenance of their purchasing power in fiat currencies and in fiat currency savings products. I share that concern. So specifically, I will sell my gold, which is to say, I will believe that the gold bull market is over when the following circumstances occur. We have a balanced federal budget. When we have a fiscal agreement in place that will allow us to honor or repudiate $100 trillion in the net present value of unfunded entitlement obligations of the US government. That's not my number. That's the Congressional Budget Office's number, okay? So when we figured out how people your age are going to get their Social Security, or we tell them honestly that they're not going to get it, when that $100 trillion problem is resolved, I'll be looking to sell my gold. But there will be one other thing. We will have to have a real positive interest rate. When I say real positive interest rate, although the government will tell you that the rate of inflation, the rate of the deterioration of the purchasing power of the US dollar is 2.6%, any of your listeners who took the trouble to compile a list of goods and services that they consume, not that the government consumes, but that they consume, we'll see that their real cost of living is escalating at 7.5 or 8% a year, which is to say, the purchasing power of their savings is declining by 7.5 or 8% a year. Real interest rate is the calculation between the yield on the US 10-year Treasury, which is about 4.5, and the rate of deterioration of the purchasing power of the US dollar, which is more like 7.5. Historically, real interest rates in the sum of about 1.5% or 2% are considered attractive. That would suggest that the interest rate paid on the US 10-year Treasury would have to be at some number like 9, up from 4.5. So I will believe that the gold bull market is over when we balance the budget, when we resolve the entitlement problem, and when either the rate of inflation falls or the yield on the US 10-year Treasury goes up. I am embarrassed to say that I believe that there is a probability of that rather than a possibility of that. I don't want people to take my word and go huddle up in the corner in fetal position and wait for a liquidity event. But I think the truth is that there are too many scary things out there. There is too much ideological division in the country and in the world, and there are too many harbingers that are negative as opposed to positive. So while I'm not saying that I think that a liquidity event is either inevitable or imminent, I think it's a probability rather than a possibility. I think it is a contingency that I absolutely positively have decided in my own portfolio to insure against. I'm running way more liquidity in my own portfolio than I otherwise would. I think people need to decide for themselves. And I would hasten to remind your audience that I'm not an economist. I'm a credit guy. It is with my credit hat on that I'm afraid about liquidity. Am I saying this is going to occur? Am I trying to scare your listeners? No. But you asked me the question around a liquidity event. And you rightly stated that in a liquidity event, all asset classes get hurt because the decision isn't made by a rational investor. It's made by a terrified investor. And more importantly, the decision's made by a margin clerk. And the margin clerk doesn't
Yes.
care what your preferences are in your portfolio. They sell whatever has a bid. It's also instructive to know that while all asset classes fall, the better asset classes recover more quickly. So in 2008, as you suggest, gold held up for a day and then sold off. But interestingly, the Fed's response to 2008 was to lower nominal interest rates and flood the market with liquidity, which caused gold to come back very, very quickly. So your investors need to remember that part of history too. Again, you need to describe yourself as an investor. If you use the word trade, the gold stocks in the last 12 or 13 weeks are up very, very, very nicely. If your orientation is to the quarter, when you're in a melt up, you have to sell. If you bought these things because you think they were underpriced and you thought when money came into the trade that they'd go up in price, the reason that you own the stock is gone. It happened. So you sell the stock. I'm an investor. I'm not a trader. If somebody gives me too much money too quickly, too easily, I will certainly take it. But my orientation is longer term. Today's gold prices are not baked in the cake with the market valuations of today's gold mining companies. As an example, we've been advising people for a very long time to own Agnico Eagle, the highest quality of the gold miners. And Agnico Eagle has done spectacularly well in the last 12 months, up 60 or 65%. We ran valuations on Agnico Eagle a year ago at $2,750 in gold. They're an unhedged producer selling gold at 3,200. We had estimated that Agnico Eagle would generate about $5 billion in cash flow in 2025, and we thought it was better than appropriately valued. We thought it was cheap, particularly relative to the quality of the company. At $3,200 gold, they're going to generate 6.5 or $7 billion, which means that even after the run up in price, they are not unattractively priced. That doesn't mean that the gold price couldn't fall back to 2,750. It doesn't mean that Agnico Eagle couldn't decline by 25%. But I think it's highly likely that while you might not be happy as a trader owning Agnico Eagle 2.5 months from now or 3 months from now, I'm not making a market call, by the way, but it's not unlikely that that would occur. I think 3 years from now, you're going to be ecstatic owning Agnico Eagle. I,
Well,
when
I
people asked me before, a year ago, so the gold prices run, but the gold miners haven't run. Why is that? That one's simple. The gold price ran until 13 weeks ago because of central bank buying. The retail and institutional buyer was non-existent. The buyer in the gold space were central banks, and they don't buy stocks. 13 weeks ago, life changed. You began to see real inflows into the retail physical ETFs, which is to say that living, breathing human beings started buying gold, not just central banks. And you got real earnings momentums in the gold stocks. And so some of the retail money that had been in other sectors of the equity market began to go to gold. There's a wonderful index, the Bloomberg Earnings Momentum Index. And traditionally, that's been big tech. That's where the earnings momentum has been. I think the last time I looked, 12 of the top 50 in US earnings momentums were gold mining companies. And that attracts investors. And that game's not over. As you suggest, there are going to be quarterly surprises uh, that are going to take people's heads off in a positive sense. Now, how long this trade lasts as a trade is a different question. For me, as an investor, if I believe, which I do, that over 10 years, the purchasing power of the US dollar declines by 75%, and I believe that it's likely that a concomitant increase occurs in the gold price, while there could be a trading interlude where the gold equities trade down, the valuations, the hard valuations, the cash generating capabilities of gold mining companies will, I believe, increase for the whole decade. You need to understand that the junior miners as a class are valueless. If you merged every junior miner in the world into one company called Junior Explorer Co., and you looked at the money that they generated either by profits or by M&A, as opposed to the money that they spent on G&A and exploration, that business, Junior Explorco, we'll call it, would lose 2 billion a year or 3 billion a year. So what do you pay for a business that loses 2 billion a year? Do you pay 8 times losses, 12 times losses? That disguises the fact that within this 3,000 company universe of Flotsam and Jetsam, 10% of the issuers generate such spectacular performance that they add legitimacy and even luster to what is effectively a bankrupt sector. There will be spectacular amounts of money made in mergers and acquisitions and discoveries in the junior sector. But those gains will be limited to the people who have the knowledge and do the work to separate, in movie parlance, the good from the bad from the truly ugly. So the headline answer to your question is yes, but there's a big qualification. To play that game, you have to do the work. Make no mistake, if you buy the GDXJ may escalate with the gold price. It may escalate from M&A, but you are owning in that index a whole bunch of stocks that you otherwise wouldn't own with a straight face. I think if somebody has a short-term orientation, if they're a trader, that the momentum is with gold today. Uh, Platinum is not in my investment account, it's in my speculative account. I own platinum because I think the zeitgeist, the narrative, is wrong. The narrative is that the internal combustion engine goes the way of the dodo in 2030, and the need for auto catalysts goes away in 2030. I believe the internal combustion engine goes away in 2065 or 2070. And so demand for auto catalysts continues for 35 years. On a net present value basis, I add a value tail, and other analysts don't. I also own platinum because I think the potential for political disruption in South Africa and or Russia, which is where platinum comes from, are high. And if you had a hiatus in supply, the price goes crazy. Here's why. $125 worth of platinum in a catalytic converter enables the sale in the Western world of a $50,000 or $60,000 car. If the price of platinum doubled, it wouldn't change the finished price of the product that the platinum enabled the sale of. There is unusual demand inelasticity around price. This is not a certainty, and so I don't hold it in an investment account. I hold it in a speculative account. The other thing I like about platinum is at current commodity prices, on a fully loaded basis, the platinum producers are losing money. They can say, well, my selling price of platinum is X, and my all-in sustaining cost to produce it is Y. Therefore, I'm generating a small margin. But that's bullshit. They don't take into account taxation, and they don't take into account the cost of capital. They're fully loaded costs, and they don't take into account, by the way, deferred sustaining capital investments, which is to say they've artificially lowered their all-in sustaining capital costs. An industry where ongoing demand for the product is insured, where the commodity price is selling for less than the total cost of production, is one where you will see a price increase.